Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I am back in New York. If you haven't noticed, I'm walking on the treadmill with my weight vest on at my building. So yeah, I like to do two things at once. I'm gonna make a quick video and I'm gonna talk about selling a covered call. This video specifically goes to my friend Joe, who sent me a message the other day talking about how he wants to sell his MicroStrategy. So he's got a bunch of stock, and part of it, he had bought some MicroStrategy when it was super low, right? So he talked about selling his MicroStrategy now that it's a bit higher. And I want to talk about selling a covered call versus, let's say, selling stock, right? So pay attention. This is going to be an amazing video. Okay, so if you have stock, you can sell stock a couple different ways, a few different ways. You could sell it at the market, right? So let's say, I mean, right now the market's not open yet because it's not 7 a.m. Eastern time yet. But let's say the market's open. You can put an order in to sell what we say at the market, right? And that means wherever the stock is trading, you're going to sell those shares at that particular price, right? And if it's a stock that trades a lot, like MicroStrategy, Tesla, you know, popular stock, there's not much what we call slippage, right? So if you're seeing that it trades at, I'm just saying, 355.5, it might be 355.5 bid, 355.52 ask. Listen, don't even worry about like what that means, bid ask. Just look at the last price. Like, where did it last trade? If you sell your shares at the market, it's gonna fill around that price, right? Or you can also put in what's called a limit price, right? You can say, let's say the stock is trading at $350 right now, $350 per share. You can say, you know, I don't want to pay attention to it, but if it goes as high as $355, let's say, as an example, I want to sell my shares. So my friend Joe was talking about putting an order in like that, right? If it goes to 355 as an example, I'm going to sell my shares. That's a limit order, right? You can also put in a stop order, right? What that means is, let's say the stock is trading at 350 right now, and let's say he bought it at 300. He might say, you know, it's come up a lot since I bought the shares, and I want to like protect like a chunk of profit that I have in this trade. So I want to put in a stop order at, let's say, 340, 345. That means if it dips below that price, you can fill it at that price. So stock orders are very, very flexible. However, this is the cool part of the video. I'm gonna send this to you, Joe, so hopefully you're watching this too. However, if you have shares, I'm just gonna use a round number. Let's say you pay $300 for your shares and it's trading at $350 right now. And you wanna sell your shares because you just made 50 bucks a shares and you're cool with that. Why would you just sell the stock? Dude, sell a covered call against it. Here's what that means. You pick the price. Let's say it's trading at 350 and you say, okay, I'm okay selling it at 350. I'm gonna put a price in. I'm gonna use that as my strike price. Now what that means is I'm paid a premium. I'm committing to sell my shares. If it goes to that price or higher, right, between now and the expiration date, you also choose the expiration date. Let's say today is Thursday. Let's say tomorrow or next Friday, and you're paid a premium. So where's the downfall? The downfall is, let's say the stock goes down, you don't sell your shares, but you still keep the premium. Or here's another downfall. Let's say the stock skyrockets high and you committed to sell your shares at like 355, but it goes to 380. Okay, you give up some upside. Listen, selling options is all about like singles, hitting singles, walking the bases. You don't have to hit a home run. You just want to hit singles and make income from week to week. So the point of my video is, just to summarize, if you have shares, you can sell shares a few different ways. You could sell market order, where it's trading at now, limit order, a little bit higher than where it is, stop order, a little bit lower than where it is to protect your position, or just sell a covered call. on it. Sell a covered call. You take in guaranteed income. It's guaranteed because you keep the premium no matter what happens. If it doesn't get filled and you don't sell your shares, you just sell another call next week. If you give up a little upside, whatever, you're giving up a little upside for consistent guaranteed, premium. So anyway, I hope this helps. Please put in the comments what your thoughts are. Do you use this sort of strategy? Do you have questions? What do you think about trading options? Hopefully you're not getting dizzy from the video as I'm walking on the treadmill with my Rogue weight vest. I'm like back in the gym, so I feel good about that. Like this video if it's helpful, and subscribe to my channel. Anyway, happy trading. See ya.